Good morning, everyone. As the sun rose over Asia's bustling financial hubs, a sense of anticipation filled the air. The start of a new week always brings fresh possibilities, but this Monday felt especially charged with energy and hope. On Monday, September 8, 2025, Asian stock markets surged, surprising many with a wave of optimism that swept across trading floors from Tokyo to Singapore. Investors and analysts alike watched as indices climbed higher, signaling a dramatic shift in sentiment after a period of uncertainty. Japan led the rally, with the Nikkei 225 hitting highs not seen in weeks, pulling other regional markets up alongside it. The excitement was palpable, as traders celebrated and market commentators scrambled to explain the sudden upswing. This wasn't just a blip. After weeks of stagnation and cautious trading, investors were suddenly ready to take on more risk. The change was sparked by a combination of fresh economic data and significant political developments, which together created a perfect storm for renewed confidence. The mood was cautiously optimistic, but the scale and speed of the movement made everyone pay attention. It was clear that something fundamental had shifted, and market participants were eager to seize new opportunities. Key drivers included softer-than-expected U.S. jobs data, which eased fears of aggressive interest rate hikes, and a political shakeup in Japan that promised potential reforms and stability. These factors combined to create a more favorable environment for risk-taking. This rally was a clear example of how quickly market psychology can shift when real-world events align. In just a few hours, the narrative changed from caution to excitement, reminding everyone of the power of momentum in global finance. In the coming minutes, let's break down what fueled this remarkable surge, explore the underlying factors at play, and consider what it could mean for the global economy as we move forward into an unpredictable week. To truly understand the recent rally in Asian markets, we first need to turn our attention to the United States, where the world's largest economy often sets the tone for global finance. What happens on Wall Street rarely stays there. Its ripple effects are felt in every major market, from London to Tokyo. Last week's softer non-farm payrolls report signaled a cooling job market. Fewer jobs were added than expected, and wage growth showed signs of slowing. For many, this might seem like a red flag for the U.S. economy, but for investors, it was a signal to start watching the Federal Reserve even more closely. While slower job growth can be worrying, investors saw a silver lining. This data increased the likelihood that the Federal Reserve might finally cut interest rates after months of holding them steady. The Fed's decisions on rates are closely watched because they influence everything from mortgage costs to the price of borrowing for businesses. Lower rates mean cheaper borrowing, encouraging both consumers and companies to spend and invest more freely. This can help stimulate economic activity not just in the US but around the world, as global capital becomes more mobile and risk appetite increases. This expectation set the stage for a global shift in capital, with Asia emerging as a prime destination. Investors began to look beyond the US, searching for markets that could benefit most from a wave of easier money. As Asian markets opened on Monday, the prospect of US rate cuts created a positive backdrop. Traders in Tokyo, Hong Kong, and Shanghai were quick to react, sensing an opportunity for growth as global funds started flowing eastward. It eased fears of an overly aggressive global slowdown and encouraged risk-taking. Investors who had been sitting on the sidelines worried about recession suddenly found reasons to be optimistic. While concerns about the U.S. economy lingered, investors focused on the likelihood of cheaper money. The hope was that lower rates would cushion any slowdown and keep the global recovery on track. This optimism helped fuel the dramatic rally, especially in Japan, where stocks surged to new highs. The mood was buoyant, with traders celebrating the prospect of renewed growth. The U.S. jobs data, rather than sparking fear, gave investors a reason to look for growth opportunities abroad. It was a reminder that global markets are always searching for the next catalyst. The anticipation of a Fed rate cut was the green light Asia needed. Investors interpreted the signals as a chance to move capital into markets with strong growth potential. Global markets are deeply interconnected. One report in the U.S. can shift sentiment across continents. The flow of information and capital is almost instantaneous, and reactions can be swift and dramatic. For now, the hope of easier money outweighed worries about economic weakness. Investors were willing to bet that central banks would step in to support growth, and that riskier assets in Asia could deliver strong returns. Investors responded by moving capital into Asian stocks and bonds, seeking both safety and opportunity. The region's markets became a magnet for global funds, eager to ride the next wave of growth. With the world watching, the stage was set for a remarkable trading day in Asia, one that could shape the direction of global markets in the weeks to come. The day's biggest story came from Japan, sending shockwaves through financial markets around the globe. Investors, analysts, and policymakers everywhere were glued to their screens, eager to understand the implications of what was unfolding in Tokyo. The Nikkei 225 soared 1.5%, a remarkable jump that caught many by surprise and set the tone for the day's trading. This surge was fueled by not one, but two major surprises that electrified the market and left traders buzzing with excitement. First, newly revised GDP data revealed that Japan's economy was expanding at a much faster pace than economists had predicted. The growth was driven by a powerful combination of robust exports, especially in technology and automobiles, and a noticeable uptick in consumer spending across the country's bustling cities and towns. This alone would have been enough to boost stocks and lift investor spirits. But then, in a dramatic twist, a political bombshell dropped that would reshape the outlook for Japan's future. Prime Minister Shigeru Ishiba, facing mounting pressure after a tough election loss, announced his resignation in a televised address. His decision immediately opened the door to new leadership and the possibility of a fresh approach to economic policy. Instead of panic or uncertainty, investors responded with optimism. Many saw this as a rare opportunity for the government to introduce more pro-growth reforms, potentially unleashing new stimulus measures and business-friendly policies. The combination of unexpectedly strong economic data and the promise of political change created a perfect storm for Japanese stocks, driving a wave of buying across the market. Investors bet heavily on continued growth, anticipating that a new government could bring additional stimulus and reforms to keep the momentum going. As a result, both the Nikkei and Topix surged to new highs, making Japan the standout performer among global markets and drawing attention from investors worldwide. It was a day of unexpected good news for Japan, and the world took notice, watching closely as the country entered a new era of economic promise and political transformation. Why did Ishiba's resignation excite investors? His fiscally conservative approach was seen as limiting growth. Now, new leadership could mean more government spending and stimulus. Investors love the prospect of fiscal expansion. More projects, more profits, higher stock prices. The Bank of Japan is also likely to keep rates low amid political uncertainty, adding to the bullish outlook. This mix of potential stimulus and steady monetary policy is a recipe for a market rally. Investors saw the shakeup as a chance for a policy reset and brighter future. Optimism about Japan's next chapter was reflected in soaring stock indices. Adding to Japan's momentum was a newly finalized trade deal with the U.S. The agreement lowers tariffs on Japanese goods, especially benefiting manufacturers and automakers. This makes Japanese products more competitive in the U.S. market, boosting sales and profits. The deal provided a concrete reason for investors to be bullish on Japanese stocks. It also strengthened economic ties between the two countries, offering stability amid global trade tensions. For investors, this reduced risk and made Japanese companies more attractive. The trade pact, combined with strong GDP data and political change, created a powerful narrative. Investors responded by snapping up shares in companies set to benefit most. While Japan stole the spotlight, China and Hong Kong told a more nuanced story. Mainland Chinese markets were cautious. Trade data showed slowing exports and weak domestic demand. After a strong August, investors took profits, leading to mixed results. In contrast, Hong Kong's Hang Seng index rose, powered by its tech sector. The divergence highlights how investors are selective, wary of China's traditional industries but bullish on tech. It was a day of contrasts: manufacturing concerns on the mainland, tech optimism in Hong Kong. The result was a complex, fascinating trading day across Greater China. The Hang Seng's rise was driven by its tech giants. Baidu jumped 4% after announcing a new note issuance, signaling confidence and future growth. Alibaba soared over 4% on the launch of a powerful new AI model, putting it at the forefront of the global AI race. Tencent also advanced, rounding out a strong day for the BAT stocks. These companies' performance lifted the entire index, showing their outsized influence. The focus on AI and innovation reflects China's push for tech self-reliance. Investors are betting on digital transformation as the key to future growth. Even with trade worries, tech remains a bright spot in Asian markets. Beyond Japan and China, the rest of Asia saw modest gains. India's Nifty 50 rose 0.3%, recovering from recent losses despite ongoing tariff concerns. Southeast Asian markets like South Korea and Singapore edged up, buoyed by global optimism and hopes for U.S. rate cuts. These small gains broke a pattern of sluggishness, signaling renewed investor interest. However, Australia's ASX 200 lagged, weighed down by domestic economic worries. Investors there sold off cyclical stocks, highlighting the impact of local factors. While global sentiment was positive, not every market joined the rally. The day showed that even in a globalized world, local issues still matter. What does all this mean for you in the global economy? It's a reminder of how quickly markets can shift on a few key developments. For investors, Japan's surge signals new growth opportunities, driven by strong fundamentals and potential policy changes. Hong Kong's tech rally shows the power of innovation, even when traditional sectors struggle. The U.S. Federal Reserve's decisions ripple worldwide. Rate cut hopes fueled optimism, but risks remain if expectations aren't met. The global economy is walking a tightrope, with central banks and political shifts in the spotlight. Ultimately, this Monday's rally was a signal. Investors are ready to bet on change, stimulus, and innovation. While challenges persist, the mood was one of optimism and a willingness to embrace new opportunities.